Hi, my name is Carl Pino, host of Janusian Economics. We explore economics and geopolitics in a rapidly changing multipolar world. To learn more, please like this video and subscribe to this channel.
You watch those nature documentaries on the cable?
Yeah.
You see the one about lions?
Yeah.
Get this lion. He's the king of the jungle. Huge mane out there. He's laying down under a tree in the middle of Africa. He's so big. He's so hot. He doesn't want to move. Now, the little lion cubs, they start messing with him. Biting his tail, biting his ears. He doesn't do anything. The lioness, she starts messing with him, coming over, making trouble. Still, nothing. Now, the other animals, they notice this, and they start to move in. The jackals, hyenas, they're barking at him, laughing at him. They nip his toes and eat the food that's in his domain. They do this, and they get closer and closer and bolder, till one day, that lion gets up and tears the shit out of everybody, runs like the wind, eats everything in his path. Because every once in a while, the lion has to show the jackals who he is. It's too late to be scared. It's time to kill. I'm going to the other room. You come out when you're ready.
Well, the premise of this video is that central banks are now deliberately trying to make us in our societies poorer. Now, this isn't a conspiracy theory. There's a popular meme going around about the World Economic Forum that says you will own nothing, but you will be happy. We're not trying to promote that idea on this channel. Instead, the purpose of this video primarily is to explain how the central banks deliberately create asset price deflation as a countermeasure against inflation. So the agenda for this video is to discuss the relationship between monetary policy and transmission mechanisms that are designed to lower inflation, but our specific focus is going to be on the asset price channel. So money in the economy is created primarily through two mechanisms. One is the creation of government debt. So when the government borrows, money is created in the economy. And when commercial banks make loans to consumers and businesses. Now, we're not going to get into all the details of this. I myself was a commercial lender in the mid-market commercial space from 1995 to 1998, 3.5 years for Toronto Dominion Bank, which became TD Canada Trust. So I was part of that money creation cycle in the economy as I was lending to medium-sized businesses. I had a $200 million loan portfolio. Now, the central bank controls the price of money, and the price of money is controlled through controlling the price of borrowing. And the central bank has two principal means of controlling the borrowing rates in the economy. And one is called one way is when the central banks set the rate at which they are willing to pay for deposits from commercial banks overnight, or that they are willing to lend to commercial banks for overnight when they want to borrow to cover their working capital needs. In so doing, they create a market and an incentive for banks to borrow and lend to each other at the midpoint of this range between which the central bank is willing to borrow and lend to individual commercial banks. This midpoint range in Canada is called the overnight rate or the policy target rate. The second way that the central banks influence interest rates in the economy is by manipulating the size of or amount of assets that the central bank owns, or manipulating its so-called balance sheet. Now, the central bank can act as a marginal buyer of short-term government bonds, and if it acts as a marginal buyer, it increases the demand for those bonds by buying more and raises the price of those bonds. And there is a relationship that the price of a bond and the interest rate of a bond are inversely related. So if the price goes up, the interest rate goes down. So by buying government bonds, it expands money supply, and by acting as a seller of short-term government bonds, it adds supply to the market, reduces the price of government bonds in the market, and raises the interest rate. So when it is selling or decreasing its balance sheet, it is raising interest rates and by decreasing the price of government bonds in the market. This is called open market operations. You've probably heard by now, unless if you've been interested in listening to macroeconomic information in the economy, about something called quantitative easing. Quantitative easing is simply when the central bank buys longer-term bonds, thereby influencing the price of long-term 10-year bonds and further out in the economy. This is a form of yield curve control. So when you are buying long-term government bonds by the central bank, you're reducing the long-term costs of borrowing. So that's right now the central banks are engaged in selling some of those longer-term bonds off their balance sheet, and that is a process that's called quantitative tightening, or QT, right now, as opposed to QE. Now, there are three monetary policy transmission mechanisms, and when the central bank changes its interest rates, it takes somewhere between 6 months to 18 months for these transmission mechanisms to work, and they work at a different rate. Now, there's three channels in which those changes take place. One of them is called an interest rate channel. And so when the central bank changes their policy rate, it lowers or raises the borrowing costs and changes the demand for consumers to make purchasing decisions, or the demand for funds in the economy for investment. There's also the asset price channel. So a lower interest rate broadly leads to higher asset prices because, again, we talked about this idea. If you can think about a home, for example, well, if you borrow against a home to buy a mortgage, and you put, say, only 5 or 10% down on the home, and you bought $1 million home, then that value of that home is essentially a debt instrument because you've got a $900,000 mortgage. Now, if interest rates come down, then the value, what do we say? We say the price of a debt instrument relates inversely to the interest rate. So a decrease in interest rate would lead to an increase in asset prices. So in general, lower interest rates in the economy lead to higher asset prices for financial assets, and that includes residential homes and commercial property, as well as stock prices, as well as debt instruments. And then the final mechanism of transmission is through the exchange rate. So when we have lower interest rates, investors in our country want to find higher places to invest their money, and they will take the money out of the country, and that will mean they'll sell our currency and buy the other country's currency, and that leads to a devaluation or a depreciation of our currency. Depreciation if it's gradual, devaluation if it's a sudden, abrupt move. And the result is a lower exchange rate, and we end up stimulating economic activity through exporting more because we have a lower, because our imports go down and the amount that we sell to other countries goes up, which is our exports, and so our net exports increase. Now, these three channels of monetary of interest rate or monetary policy changes of the short-term interest rate, as I said, can take 18 months to fully work their way through the system, but they work at different speeds. So asset price channels work fast. So when the central bank changes its interest rate policy, that's immediately reflected on what you can, on borrowing costs for mortgages, for both residential and commercial properties, interest rate, like debt instruments in the economy, like provincial government debt, corporate debt, they immediately get adjusted according to this changes in this interest rate. So this asset price channel is a very, very quick channel of response. Now, the interest rate channel itself, which is where consumers and businesses change their borrowing decisions on the basis of the fact that the cost of borrowing has gone up or down, takes longer. It's a medium to slower change. Now, you can imagine that sometimes if you're in the middle of doing a project, let's say you're a business that's in the middle of you've got a 5-year development project for something like the oil sands, you're not likely going to stop your project or change much in terms of your investment decisions immediately because you are in the middle of developing a long-term capital project. People and businesses don't immediately adjust their behavior. It comes in a medium or slower process. And then exchange rates are slow because a lot of times when you're making commitments to bring things in from China and or sell, those commitments are longer term in nature. You've set up a contract, and that contract's going to run for the next year. And so it takes a while for those contractual obligations to run themselves out and for supply and demand to readjust themselves. So it tends to be the slowest of the three channels. Now, in the last decade, we had 2 times in which the Bank of Canada had to intervene since 2015 to help bolster the economy through a monetary policy. Now, one of the things that happened in 2015 is that oil went from over $100 a barrel to around $50 a barrel, even dipping below $50 a barrel at the end of 2014. And oil being worth half of our net exports, this was a tremendous blow to our economy, not to mention the fact that the regional Western economy depends heavily on the price of energy. And so Stephen Poloz, our Bank of Canada governor at the time, he cut short-term interest rates, our policy rate, in order to stimulate the economy. The idea was that we would end up with lower exchange rates. This would stimulate our export sector. But what really happened was the interest rate cuts caused real estate prices in Vancouver and Toronto to rise dramatically. So we ended up with the low interest rates, housing in Canada grew. And we've had a supply issue with housing in Canada because we have very high levels of immigration. And so our immigration is running somewhat 300,000 plus people every year. And Vancouver and Toronto end up being the places where immigration is, where people at least initially move to the most. So people took out bigger mortgages and started using their homes like an ATM, where if those asset prices went up, maybe we take out a home equity line of credit and we go on a vacation, or we buy a boat, or we buy a second property. And so this ended up causing a lot of credit expansion in Canada. And if we look at today, we see that in Canada, spending on residential real estate and finance exceeds research and development and capital expenditures by our corporate sector. So we've switched to an economy that is highly reliant on our real estate sector. Now, there was another rate cut, of course, that came in 2020 at the start of COVID, and it was a 50 basis point cut. And again, the theory was that our economy was going to slow down. We were going to be have a lot of people who were not going to be able to go to work because of the lockdowns. The Bank of Canada is worried that household income would be in trouble, and putting as a result, household asset prices might fall. And so if housing becomes broken, residential mortgages are about 30% of the assets on our commercial banks' balance sheets, and this could jeopardize the banking system. So in order to put essentially a floor on asset prices, or the fall of asset prices.
Obviously, you made it clear that you were moving towards a cut before the recent events. What exactly were you watching that made you go the 50 points? I mean, in other words, what do the data show about COVID-19 specifically?
Well, what we're seeing is a very rapid spread to many more countries over the past weekend. Indeed, there was a big move. And one of our closest case studies is in Italy. So that's a great insight for us on how things are going to get disrupted very quickly, and what sort of fallout to expect. So that's been helpful as we've gone through this decision-making cycle. So now what we want to know is, what does the future look like? And if consumer confidence will erode because of the virus, then you expect to see a downdraft in housing. And so the interest rate move this week is intended to address exactly that. So it should help stabilize housing as opposed to pour extra fuel on a hot housing market. So that's a difference than if in the past we may have been thinking of cutting rates because exports were weak. And you're trying to boost housing to compensate for weak exports. Well, then you really are adding to vulnerabilities. And so the trade-off looks different depending on what the underlying shock is. I think it's a really important distinction here, Amanda.
And again, we had another boom in housing prices that happened and the effect on housing prices was more pronounced than the effect on investment or net exports. So what we've seen in Canada, and again, this is underscored by the fact that we have always have strong demand for new housing because of our immigration policy, we've seen that these interest rate increases have led, or decreases rather, and have led to home asset prices growing in our larger centers dramatically. So what are the causes of our current high inflation? Because we've lived in the West for much of the last 20 years in a low inflation environment where inflation has been bounded between 1% and 3% a year often. And now we've got inflation that was approaching double-digit levels or exceeding it in much of our Western economies. Well, right now, our global supply chain is messed up. We've got China locked down because of zero COVID, and so they're not producing near as much for the rest of the world as the manufacturing hub of the world. We have an energy shortage. We have had a U.S. labor market shock due to COVID. So we had over 1 million official deaths from COVID. There are lots of people who have been labor impaired, called long haul COVID workers. I myself am a long haul COVID worker. I've been fatigued and impaired in terms of my ability to work since I contracted COVID. And there have also been a number of people who have been closer to retirement age and who've seen their home prices and stock market prices go up as a result of the expansionary monetary and fiscal policies that were a response to COVID, that they've decided to essentially drop out of the workforce, retire early, and so you've had people leaving. Now that kind of relates to the demand side conditions that were created. So the U.S. money supply in the last several years broadly expanded by 40%. That was done because of the spending spree that the U.S. government went on to support the economy for COVID, and that was essentially financed by the central bank purchasing the new issuance of the federal government debt. And of course, they lowered interest rates. And so having really low interest rates fueled housing prices, along with the government spending that fueled demand. And that has led to corporate higher demand for housing in the United States, led to higher demand for all kinds of goods and services. And in general, the corporate profits went up because the U.S. government went into very heavy deficit spending to support the economy during the COVID crisis. And of course, we did the same here in Canada as well, running massive federal deficits through a program called CERB. And we are now dealing with the I think in many ways, at least the initial CERB, the 2020 economic support was valuable, and there's was of course problems with fraud that we're now finding out, but the government probably responded as well as it could in a once in 100-year emergency that they weren't otherwise ready for. Now, during that COVID era, if we look relative to government bonds, housing did quite well in the United States, as did the S&P 500, which is the broad index of the 500 largest market firms that are traded on the stock market by market capitalization in the United States. And so in general, we saw, and corporate bonds did well because interest rates were lowered as well. So asset prices increased. Again, that's led to some wealth effects where people have dropped out of the economy. Now, the San Francisco Federal Reserve has done some research in terms of breaking down, if you take inflation and you've got inflation that is, say, 8%, and you say 2% would be a normal inflation, then the remaining 6% of inflation, they break it down and they say that 4% of that inflation is what we would call supply-driven, and 2% of it is what's called demand driven. Now, loosely speaking, if most of it if there's twice as much of an impetus of inflation coming from a supply shock, why then is the central banks focusing on supply, or why are we concerned about the it might appear that we're overly concerned with the demand-driven factors. So let's put it that way. We've seen interest rates rise at an unprecedented pace and an unprecedented magnitude in modern history in terms of the level of by the central bank. And the central banks are typically trying to address, they basically only have the power to address demand factors. Most of their ability to influence the economy is through demand. But here's some comments from the chairman of the Federal Reserve, Jay Powell, on March 2022. Overall, the labor market is strong, but showing a clear imbalance of supply and demand. Our monetary policy tools cannot help with labor supply in the near term, but in a long expansion, the factors holding back supply will likely ease. In the meantime, we aim to use our tools to moderate demand growth, thereby facilitating continued sustainable increases in employment and wages. So what the Federal Reserve is saying there is, well, we can't really do anything for supply, but we can influence demand, and if we are able to get rid of the demand issues, supply will, in the long run, with proper monetary policy on the demand side, will take care of itself. Now, there's a fear, and that expectations of higher inflation become the norm in our society. So right now, we're living in a society where we've been used to inflation being low and stable, somewhere between 1% and 3% most years. And in the 70s and 80s, we had high inflationary expectations in our economy because we had run high inflation for a long period of time. And that took us some severely high interest rates that short-term interest rates that approached 20% in the United States and Canada, in order and required the provoking of a large, deep recession in order to get inflationary expectations under control. So a lot of what's going on here with respect to central bank policy is a fear that people will begin to believe that inflation is going to be higher in the future and longer, and that these inflationary expectations will become self-perpetuating. And in the Jackson Hole Summit, every year the Federal Reserve attends a conference in Jackson Hole, Wyoming in late summer. And again, Jay Powell said at the 2022, this summer's Jackson Hole conference, that the longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. So this is the sum of all fears for the central banks, that consumers and businesses will begin to expect higher inflation in the future. So if your primary concern is that inflation is going to stick around too long because it'll take a while for the supply conditions of inflation to fix themselves, and your only tool is to deal with demand-side inflation, but you're worried about if inflation stays too high too long, that you'll get entrenched expectations of inflation, then you need to put pressure on that mechanism, which will most quickly bring down aggregate demand and hence push back in a deflationary way on the economy. And that, of course, is the asset price channel. So the asset price channel, particularly with home prices and stock market and bond market, is a way to reduce the wealth of individuals and create a deflationary pressure in the economy. Now, if we look at some comments from Carolyn Rogers, who is the Deputy Governor of the Bank of Canada, she gave a speech in November of 2022. And she said, in addition, house prices are also coming down, albeit modestly so far, relative to their recent increase. We need lower house prices to restore balance to Canada's housing market and to make home ownership more affordable for Canadians. But lower house prices may add stress for those people who purchased recently. They will have reduced equity, and this may limit their options to refinance. So they're understanding that that they need to rein inflation in Canada. We need to put pressure on the housing market. Now, we can look at the Housing Affordability Index in the United States, for example. So on the left-hand side of the panel, on the bottom graph, we see the drivers of affordability. And the drivers of affordability, we can see that the two most significant drivers of the affordability in the United States that have caused affordability to be 30% below baseline are the interest rate changes that they had. So when they took interest rates low, and the price changes. Now, those price changes, of course, were also fueled by the COVID crisis, people moving around because of COVID, as well as the rise in the stock market and bond market, their profitability of their investment portfolios. Now, if we're looking at the right-hand side of the panel, again, we can look at the affordability, the share of income needed to own a median priced home in the United States has gone up from 30% pre-COVID to 45% or more. The green line is the urban centers, and the orange line is rural centers. And in the rural pre-COVID, you needed about 25% share of income needed to own a median price home. Now you need over 40%. So again, it's another measure of saying that house value have expanded relative to individual. Their prices of homes in the United States have expanded relative to people's incomes. So if we want to do a comparison in Canada, and if we're looking at Toronto and Vancouver, then we need house prices to fall somewhere around 40% to get to 2019 levels of affordability. Now, the Bank of Canada's job in getting housing prices to fall in Toronto and Vancouver by that much, which they would like to see, is made more difficult by the fact that we have 500,000 new immigrants in Canada every year, and those immigrants are generally earning higher than average Canadian salaries, and they're coming with some wealth, often from other countries, and that is going to make that kind of creates an inherent demand price push in Canada for housing. So that task of readjusting the home prices in Canada to 2019 levels is a more challenging task for the Bank of Canada than it would be for the Federal Reserve to achieve a comparable level of adjustment in the United States. But that is why we can expect to see interest rates higher for longer, because the Federal Reserve will want to make sure that our wealth gets lower, and so that we kill demand and we choke off inflation. Of course, myself and Michael are dubious that inflation is going to be able to be fully restored back into that 1 to 3% level because of supply conditions, and we'll talk about that momentarily. But in the meantime, we've definitely seen some wealth effects in the United States. There was over $6 trillion of wealth lost just in the second quarter of 2022 alone. So we've seen the demand for wealth-sensitive items, Rolexes, homes, and cars, start to fall dramatically. Wealth effect of holding assets in interest-sensitive assets has grown over the years. And so if we look at where we are in 2020, and look at Canada, over 70% of Canadians' wealth is captured in their homes, and stock and bond portfolios, and in their retirement pensions. So these are all interest-sensitive assets. So this is what the Bank of Canada is counting on in terms of reducing demand and thereby reducing home prices in the major centers in the Canadian economy. Now, there's an argument to be made that the central bank policy, in a way, is counterproductive in the long run. Now, let's get there. First of all, what we've, even by the central bank's own admission, 2/3 of the inflation we're seeing in the economy right now is being driven by supply side issues. So if we don't have, if we're not going to address supply side issues, then we're not going to be able to deal with supply side inflation over the medium to long term. So or even short term, of course, by definition. Now, let's take energy policy. Everything that we consume requires oil. And if we have an energy shortage, we're going to see in the future, because we're still in a period 8 years on where we've been underinvesting in oil production. So last year, to the tune of $150 billion, we're going to get declining oil production while demand for oil continues to be stable or even growing. And so that's going to continue to put supply side pressures in the economy. When you have raised the short-term interest rate to the point that now short-term interest rates are higher than long-term interest rates, you've inverted the yield curve in the economy, you now have created a higher cost of capital, which creates economic growth uncertainty, because usually when the yield curve is inverted, you end up with a recession. So you're going to diminish investment, and you're going to, of course, consumer demand itself is going to fall off, and that's going to be a diminishment for investment. So in general, that investment is what fuels our long-term supply in our economy. So monetary policy is an indiscriminate measure that knocks out consumption, investment. Now, a better move would be, from a policy perspective, would be higher personal income taxes and targeted investment credits and lower government spending. So it would be better if you were trying to manipulate the economy more on the fiscal side than on the monetary side. And if you had government reducing its spending, while it was providing incentives for, say, housing supply and energy supply in the economy, and restraining personal consumption, especially at the top of the income pyramid, through higher personal taxes.
When you look out a little farther, my take on it is that they really did not focus at all on the investment side, where we have a long-running problem, and focused far too much on boosting personal and government consumption, which we probably really do not need in 22 and 23. And so don't feel that we really needed any support for consumption as we move out there. In investment, though, still lags, and that's both on the private side and on the public side.
So when we do look at the spending that was offered up in the budget, we know, David, that the government wants us to see it as an investment for growth kind of budget. There may be some of that, and some of it may only play out over time. But how much of the actual spending in the recent budget will actually stimulate the economy in a fairly direct fashion, in your view?
Well, being generous, I would say of the additional roughly $100 million, being very generous, 20 or 25% of that is for growth. The rest is actually to boost consumption, as I say, both public and private consumption. I guess that was the question in my mind as to why at this point we would actually be boosting that side. On the investment side, as I've said, there is good reason to think we need to invest more over the coming couple of years.
So what would you think that should look like? If we're designing it, what should that investment be shaped as?
Well, broadly speaking, let me just do broad speaking. We need investment in our oil and gas sector, and what we are doing and what we need to do in the energy sector writ large. Because remember, energy is a major export for us, and if we're going to pay our bills, we have to be able to sell something abroad to replace that. Secondly, in Ontario in particular, we've got a manufacturing sector which has been based on the internal combustion engine, and that requires change. So we need to build a new ecosystem, if you will, in that regard. And finally, the one thing they did hint at, which is absolutely correct, is the digitalization of our service economy. We really do need to focus on that, including the financial sector, which Mr. Pence did not mention at all.
So in our next video, we will follow up with our third and final video in the new year on the energy crisis and suggested policy solutions. And we will talk about this idea of that is been put forward or coined by a Wall Street analyst, Zoltan Pozsar, called Bretton Woods 2.0, and the possible return of gold to play a significant value as a monetary asset for countries involved in trade with each other. Thank you, Janusians, for supporting the channel and watching. On behalf of Michael and myself, I wish you happy holidays, and I hope to see you again on the channel in the new year. All the best. Enjoy your family and friends in this holiday season, and we'll see you again in the new year. Cheers.